For over 7 decades, the US dollar has reigned supreme as the world's reserve currency. It's been the language of global trade, the anchor of financial stability, and the foundation upon which the modern economic order was built. But something fundamental is shifting beneath our feet. A coalition of emerging powers, Brazil, Russia, India, China, and South Africa, now expanded to include Iran, Egypt, Ethiopia, the UAE, and Indonesia, is constructing an alternative financial architecture that could reshape how money moves across borders. This isn't just another headline about geopolitical rivalry. This is about the quiet revolution happening in central banks, digital ledgers, and gold vaults across the developing world. The question we're exploring today isn't whether the dollar will disappear overnight. It won't. The real question is whether we're witnessing the beginning of the end of dollar dominance and what that means for all of us. Let's start with some numbers that should make us sit up and pay attention. In 2001, the US dollar accounted for 72% of global foreign exchange reserves. By the third quarter of 2025, that figure had fallen to 56.9%, the lowest level since 1994. That's a 15 percentage point decline in roughly 2 decades. Now, you might think that's still a comfortable majority, and you'd be right. But the trajectory tells a different story. Central banks around the world are actively diversifying away from the dollar, and they're doing it for reasons that go far beyond simple portfolio management. The turning point came when the US began using the dollar not just as a currency, but as a weapon. When sovereign reserves can be frozen with a stroke of a pen, when entire nations can be cut off from the global payment system for political reasons, something changes in the calculus of central bankers. If your reserves can be seized because of foreign policy disagreements, they're not really safe assets anymore, are they? Russia learned this lesson the hard way. So did Iran. And the rest of the world took notice. Here's what makes the BRICS approach so fascinating. They're not trying to create a single currency that competes directly with the dollar for everyday transactions. That would be economic suicide. Instead, they're building something more sophisticated, a parallel infrastructure that gives countries options. Think of it as constructing a new highway system while the old interstate still functions. You're not tearing down the existing roads, but you're making sure you're not trapped if someone decides to close them. The strategy operates on 3 levels, and understanding each one is crucial. First, there's BRICS Pay, a decentralized payment system designed to link national payment networks directly. India's UPI, Brazil's PIX, Russia's SPFS, all connected without requiring dollars as an intermediary. The goal is simple: reduce transaction costs by 30 to 50% and eliminate the settlement delays that come with routing payments through Western clearing centers. More importantly, it's sanctions-proof. No single country controls it, so no single country can shut it down. Second, we have the explosion of central bank digital currencies. By early 2026, all 5 core BRICS members are running CBDC pilots. China's digital yuan has already processed 3.4 billion transactions. India's e-rupee has attracted 7 million users. These aren't experiments anymore, they're becoming production-ready infrastructure. And in January 2026, India's Reserve Bank proposed something remarkable: connecting these digital currencies to facilitate trade, remittances, and tourism payments across member nations. Third, and perhaps most intriguing, is something called the unit. This is where things get really technical, but stay with me because it's brilliant. The unit is a gold-anchored settlement instrument designed specifically for international clearing between central banks. It's not meant for you to buy coffee with. It's for settling trade balances between nations. The structure is elegant: 40% backed by physical gold, 60% by a basket of BRICS currencies. This mimics an idea that economist John Maynard Keynes proposed back in 1944 called the Bancor, a supranational currency for settling international accounts. The genius is that because the unit can't be redeemed by individual holders, only at the node level during structured exits, it prevents bank runs on the underlying gold reserves. Speaking of gold, let's talk about what BRICS central banks have been doing quietly over the past few years. Between 2020 and 2024, BRICS nations purchased over 50% of the global gold supply. Annual purchases have exceeded 1,000 tons. India alone now holds over $100 billion worth of gold in its reserves. This isn't accidental. When you can't trust that your dollar reserves will be there tomorrow, you accumulate assets that can't be frozen, sanctioned, or controlled by any foreign government. Gold becomes more than a hedge against inflation, becomes insurance against geopolitical risk. Here's where theory meets reality. By the end of 2024, approximately 90% of trade between Russia and its BRICS partners was settled in national currencies. China and Brazil successfully settled 25 to 30% of their bilateral trade in local currencies, bypassing the dollar entirely. India settled 100% of its trade with BRICS partners in rupees starting in August 2025. This isn't some distant future scenario. It is happening right now. The mBridge platform, a multi-CBDC system piloted by China, Hong Kong, Thailand, Saudi Arabia, and the UAE, processed transaction volumes surpassing $55 billion by late 2025. More importantly, it settles payments within seconds at half the cost of traditional systems. Compare that to the typical 2 to 5 day settlement window in the SWIFT system, and you can see why countries are interested. The most telling development came when the Bank for International Settlements, often called the Central Bank of Central Banks, withdrew from the mBridge project in late 2024. Officially, they said the project had graduated from their innovation hub. But analysts suggest the real reason was more political. The BIS couldn't legally support a platform that might include sanctioned countries like Russia and Iran. China simply continued development independently. There's a theoretical framework that explains why all of this matters, and it's called the Triffin dilemma. In the 1960s, economist Robert Triffin pointed out a fundamental contradiction in the Bretton Woods system. The country whose currency serves as the global reserve must run persistent trade deficits to provide the world with liquidity. But those same deficits eventually undermine confidence in the currency's value. In the modern era, this has evolved into what some call the fiscal Triffin. Global demand for safe assets, primarily U.S. Treasury bonds, forces the United States into excessive debt issuance. U.S. debt now exceeds 110% of GDP, compared to about 60% for emerging markets. In 2025, Moody's downgraded the U.S. credit rating, intensifying questions about the long-term sustainability of dollar-denominated assets. Meanwhile, the U.S. economy's share of global GDP continues to decline relative to the rising BRICS nations. The bloc now accounts for over 40% of the world's population and approximately 30% of global GDP. In 2024, BRICS plus nations produced 42% of global oil output. That kind of economic weight gives you leverage over pricing in settlement terms. The math is straightforward. If the rest of the world needs dollars to trade, but the U.S. can't supply sufficient safe assets without destabilizing its own finances, something has to give. While the headlines focus on currencies, something equally important is happening in debt markets. The new development bank, the BRICS Development Finance Institution, has dramatically increased its issuance of local currency bonds. By December 2025, it had issued 78.5 billion yuan in Chinese panda bonds, supporting infrastructure projects without introducing exchange rate risk. India's local currency bond market reached 53.6 trillion rupees in fiscal 2025. The Asian Development Bank issued a 12.5 billion rupee green masala bond to finance renewable energy projects. These instruments allow BRICS plus nations to tap international capital while shifting currency hedging costs to investors. What does this mean practically? It means these countries are building the capacity to borrow in their own currencies for international projects. That's a privilege historically reserved for the United States. If you can borrow in your own currency, you don't face the exchange rate risks that have triggered so many emerging market debt crises. It's financial sovereignty in its most fundamental form. Unsurprisingly, the United States isn't thrilled about any of this. President Trump repeatedly threatened 100% tariffs on goods from BRICS nations if they backed a new currency to replace the dollar. In July 2025, he proposed an additional 10% tariff on any country aligning with BRICS policies. The reaction from BRICS leaders has been carefully calibrated. Vladimir Putin, despite displaying a prototype BRICS banknote at the 2024 Kazan summit, stated that Russia wasn't seeking to abandon the dollar, just being forced to find alternatives. India's external affairs minister emphasized that the dollar remains a source of global economic stability and that India has no policy to replace it. This rhetorical dance matters. None of these countries want to be seen as actively trying to destroy the dollar-based system. What they want is optionality. The ability to operate if and when access to that system is denied or becomes disadvantageous. The 18th BRICS summit, hosted by India in 2026, could be the moment when much of this infrastructure moves from pilot projects to operational reality. The agenda includes formalizing CBDC interoperability, potentially launching BRICS Pay as a unified payment system, establishing a BRICS grain exchange for agricultural commodities, and pushing the new development bank toward its target of 30 to 40% of financing in local currencies. If even half of these initiatives succeed, analysts estimate that up to 15% of global trade could move to CBDC-based systems by 2030. So, is this really the final nail in the dollar's coffin? Here's the honest answer. No, not in the way the question implies. The dollar isn't going to collapse. It won't suddenly become worthless. The United States still has the world's deepest financial markets, the strongest military, and decades of institutional trust built into the system. Network effects are real, and they're powerful. But that's not the right question anyway. The right question is whether the dollar, its monopoly, its ability to serve as the exclusive vehicle for global trade and the ultimate safe asset, is ending. And the answer to that question is almost certainly yes. What we're witnessing is the gradual marginalization of the dollar in specific corridors of trade, particularly among countries that feel vulnerable to U.S. foreign policy decisions. We're seeing the construction of parallel systems that don't require dollar intermediation. We're watching the emergence of alternative sources of liquidity and safety that don't depend on U.S. fiscal health or political stability. This transition will be messy. We'll likely see a period where regional blocs operate parallel systems alongside traditional dollar infrastructure, a fragmented global order rather than a unified one. Transaction costs might increase in some areas as liquidity fragments. There could be efficiency losses from maintaining multiple systems, but for the BRICS S+ nations, these costs are worth it. Financial sovereignty, the ability to trade, invest and borrow without permission from Washington, is priceless when your foreign policy sometimes conflicts with American interests. The dollar's coffin doesn't have one final nail. It has 1,000 small ones, each representing a trade settled in yuan, a CBDC transaction between central banks, an ounce of gold added to reserves, a local currency bond issued to international investors. Individually, none of these matter. Collectively, they're reshaping the architecture of global finance. The American century in currency dominance may not be over, but we're definitely in the final chapters. What comes next, whether it's a multipolar currency system, regional monetary blocks, or something we haven't imagined yet, will define the economic order for the next generation, and that transformation is already underway.